Your bank can freeze every dollar you own, and there is nothing you can do about it for up to 10 business days. Not a conspiracy theory. Federal law, Regulation CC. And the average American family has exactly $430 in liquid cash outside of their bank account. $430. If your bank freezes tomorrow morning, how long does your family survive? My name is Emily, and 3 years ago I found out what a bank freeze actually feels like from the inside. It was a Friday afternoon, 2:47 p.m., and I was standing at a Target checkout with my daughter's birthday groceries on the conveyor belt. Balloons, cake mix, the specific brand of juice boxes she asks for every year. I swiped my debit card. Declined. I thought it was a reader error. Swiped again. Declined. I felt my face go hot. The cashier had that specific expression, patient, practiced, that told me she'd seen this 100 times. I stepped aside and called my bank from the parking lot. 42 minutes on hold. When someone finally answered, they told me my account had been flagged for a routine security review and access was temporarily restricted. Temporarily. My daughter's birthday was the next morning. I had $11 in cash in my wallet and a car that needed gas. That was the moment I understood that the money in my bank account does not actually belong to me in the way I thought it did. Here is the math that most Americans have never seen, and banks have no interest in showing you. There are approximately 144 million American households. The average household checking account balance is $8,329. That sounds reasonable. But the median, the number that reflects what most actual families have, not the average inflated by wealthy accounts, is only $1,200. $1,200. That is the real financial buffer standing between the average American family and complete crisis if their bank account becomes inaccessible. $1,200 covers approximately 9 days of average American household expenses. 9 days. And that's assuming every dollar is immediately accessible, which, as we're about to discuss in detail, is a guarantee that does not legally exist. In 2023, 3 American banks collapsed in the span of 8 days. Silicon Valley Bank on March 10th, Signature Bank on March 12th, First Republic Bank on May 1st. Combined assets, $548 billion. More than the entire GDP of Sweden. And while most news coverage focused on tech startups and venture capitalists losing money, what almost nobody reported was the 212,000 ordinary account holders at these banks who woke up on a Monday morning and could not access their money, some of them for days, some for weeks. One small business owner in San Jose had her payroll account at SVB, $173,000 she needed to pay her 12 employees that Friday. She spent 4 days not knowing if she could make payroll. Her employees had mortgages. They had children. They had car payments due that week. This is not a theoretical risk. This happened 18 months ago to real families. In this video, I'm going to show you exactly how to protect your family from a banking disruption. Not theoretically, but with a specific system I built after my Target parking lot moment that cost me one Saturday afternoon to set up and gives me complete peace of mind about money access, regardless of what any single bank does. 5 steps. Concrete numbers. Exact mechanisms. By the end of this video, you'll know exactly how much cash your family needs and where to keep it, which accounts to use and which to avoid, how FDIC insurance actually works versus how most people think it works, and the one financial structure that means a bank collapse never touches your family's daily life. Each step takes between 15 minutes and 2 hours to implement. The whole system maintains itself after that. But first I need to explain why intelligent, careful people are completely unprepared for this. Because the banking system is designed to make you feel safe in a way that is not entirely accurate. In 2016, researchers at the University of Southern California published a study on what they called institutional trust bias, the documented human tendency to extend deep, unquestioning trust to institutions that have official-looking logos, government associations, and long operational histories. Banks score higher on institutional trust than almost any other type of organization in America. The FDIC logo on the door, the marble lobby, the professional staff, the decades of advertising telling you your money is safe. This trust is largely warranted. The U.S. banking system is genuinely one of the most stable in the world. But warranted trust and unconditional trust are 2 different things, and the gap between them is where families get hurt. When we trust an institution unconditionally, we stop monitoring it. We stop preparing for its failure. We structure our entire financial life around its uninterrupted availability. And then when interruption happens, not collapse, just interruption, just a Friday afternoon security review, we are standing in a Target parking lot with $11 and a birthday party in the morning. You are not naive for trusting your bank. You were culturally trained to. But the families who survive banking disruptions without crisis are not the ones who trusted more or less. They're the ones who built simple, concrete redundancy into their financial lives before they needed it. That redundancy is what this video is about. Let me show you 3 families, all earning the same household income, $82,000 per year, all with children, all with mortgages, all living in the same mid-size American city. The Garcia family, the Thompson family, and the Rivera family. The Garcia family does what most families do. All income goes into one joint checking account at one bank. Bills auto-pay from that account. The debit card is connected to that account. They have a savings account at the same bank with $4,000 in it, their emergency fund. One bank, one institution, total financial life in one place. It feels organized. It feels simple. When their bank experiences a regional system outage in February, not a collapse, just a 48-hour technical failure, the Garcias cannot pay for groceries, cannot fill their gas tank, cannot access their savings. For 48 hours, their family functions on what's in their wallets, $63. They survive the 48 hours. But it takes 3 weeks for their blood pressure to return to normal. The Thompson family felt the urgency after reading about SVB. Mark Thompson opened a second checking account at a different bank. He means to transfer some money into it regularly. He has not done this consistently. The second account has $211 in it. When the Thompsons face a banking disruption, they have access to $211 at a second institution. Better than the Garcias. Still not a system. Still not protection. Still a family that could not cover a week of expenses from their backup resources. The Rivera family spent one Saturday building a specific redundancy system. They have checking accounts at 2 separate banks. Not the same banking group, different institutions entirely. They maintain a specific cash reserve in a fireproof home safe. They have a high-yield savings account at an online bank, separate from both checking accounts. Their credit card, paid in full every month, is from a third institution entirely. When the Riveras face a banking disruption at their primary bank, their daily life does not change. Bills continue to auto-pay from account 2. Groceries get purchased on the credit card. The cash reserve handles any immediate cash needs. The disruption is administratively annoying. It is not a crisis. Their children do not notice. Same income, same city, same mortgage. 3 completely different outcomes from one variable: system versus assumption. Now let me show you how to build the Rivera system, step by step, with exact numbers. Step 1 is understanding what FDIC insurance actually covers, because most Americans have a version of this in their head that is dangerously incomplete. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor, per bank, per account ownership category. That sounds comprehensive, and for most families it is. But here are the specific ways people get hurt by misunderstanding it. First, the $250,000 limit is per bank, not per account. If you have a checking account with $150,000 and a savings account with $150,000 at the same bank, you have $300,000 at one institution. FDIC insures $250,000 of it. The remaining $50,000 is uninsured, gone in a collapse. Most middle-class families are nowhere near this number, but the 1% of families who are near it frequently don't know they're exposed. Second, FDIC insurance covers your deposits, but it does not guarantee immediate access. When a bank fails, the FDIC takes over and works to make insured depositors whole. But the process takes time. In the SVB collapse, most insured depositors had access to their funds within 72 hours. But 72 hours with no bank access is 3 days of no groceries, no gas, no rent payment, no access to your own money. For a family living paycheck to paycheck, which is 57% of Americans according to a 2023 LendingTree survey, 72 hours without account access is not an inconvenience. It's a genuine crisis. Third, FDIC insurance does not cover investment accounts, brokerage accounts, mutual funds, stocks, bonds, cryptocurrency, or contents of safe deposit boxes. It covers deposits, checking accounts, savings accounts, money market deposit accounts, CDS. That's it. If you have money in any other type of account at a bank that fails, FDIC is not coming for you. I didn't know any of this until I spent 4 hours reading FDIC documentation the week after my Target parking lot incident. And I remember sitting at my desk afterward thinking about how confidently I had assumed I was protected when I had never actually read a single sentence about what the protection covered. This step, reading the FDIC coverage rules and auditing your own accounts, takes 45 minutes. Do it once, and you will never have a false sense of security about your deposits again. Step 2 is building your liquid cash reserve. And I want to give you a specific number right now, because most financial advice on this topic is frustratingly vague. Your household needs a minimum of $1,000 in physical cash in mixed denominations, not all hundreds, because in a genuine disruption scenario, ATMs run out of small bills first, stored somewhere secure in your home. Not in your car, not in a safe deposit box at a bank that might be inaccessible. In your home. In a fireproof lockbox that costs between $30 and $60 on Amazon. Why $1,000 specifically? Because $1,000 covers the average American family's essential expenses: groceries, gas, critical medications, for approximately 7 to 10 days. That is longer than any banking system disruption in American history has lasted for ordinary depositors. The longest disruption for insured depositors after a bank failure was the IndyMac collapse in 2008. Account holders had full access within 5 business days. $1,000 in cash at home gets your family through any realistic scenario with room to spare. I remember going to the bank to withdraw my first cash reserve. I was standing at the teller window asking for $800 in mixed bills, and I felt almost embarrassed, like I was doing something slightly strange. The teller didn't blink. She counted out the bills, I put them in an envelope, and I drove home and put them in the fireproof box I'd bought the week before. And that was it. That was the entire step. 30 minutes total, including the drive. And now, every time I open that box to confirm the cash is there, which I do approximately twice a year, I feel something that I can only describe as quiet power. The knowledge that my family's immediate needs are covered, regardless of what any bank decides to do with my account on any given Friday afternoon. Beyond the emergency cash, your liquid reserve target is 3 months of essential household expenses, held across at least 2 separate banking institutions. Not your total monthly spending, your essential expenses. Mortgage or rent, utilities, groceries, transportation, critical medications, and insurance. For the average American family, this number is approximately $6,000 to $9,000. 3 months of essentials at $2,000 to $3,000 per month. This is your true emergency buffer, not the vague 3 to 6 months of expenses that every financial article mentions, but specifically your essential only number held at multiple institutions, so no single bank failure can make it inaccessible. Step 3 is the 2-bank structure, and the specific way you build it matters more than most people realize. You need 2 checking accounts at 2 completely separate banking institutions, not 2 accounts at the same bank, not 2 accounts at banks owned by the same parent company, 2 genuinely separate institutions with no corporate relationship. Here's why the corporate separation matters. When Washington Mutual collapsed in 2008, the largest bank failure in American history, $307 billion in assets, it was acquired by JP Morgan Chase overnight. Customers of WAMU suddenly found their accounts at Chase. The transition was mostly smooth, but there were 48 hours of uncertainty during which customers didn't know exactly what was happening with their money. If your backup account is at a bank owned by the same holding company as your primary account, a holding company level disruption could potentially affect both simultaneously. Use 2 genuinely separate institutions. The structure I use, and that I recommend, is this: primary checking account at a large national bank. Major national banks, JP Morgan Chase, Bank of America, Wells Fargo, Citibank, have the deepest federal regulatory relationships, the most robust backup systems, and historically the fastest resolution times during disruptions. Secondary checking account at a credit union. Credit unions are member-owned nonprofit financial cooperatives. They are insured by the NCUA, the National Credit Union Administration, rather than the FDIC, which means your deposits at a credit union are insured by a completely separate government entity from your bank deposits. Two accounts, two separate government insurance programs, zero corporate relationship between the institutions. Here is how you fund the secondary account. Transfer 1 month of essential expenses. Let's call it $2,500 for the average family, to your credit union checking account and leave it there permanently. Set up your secondary bills, the ones that don't require your primary bank's bill pay system, to auto pay from the credit union account. This way, if your primary bank becomes inaccessible, your secondary account is already funded, already active, already connected to real expenses. You don't need to scramble to transfer money during a crisis because the money is already there. Setting up a credit union checking account takes approximately 45 minutes online. Finding the right credit union takes about 15 minutes. Go to mycreditunion.gov, enter your zip code, and find a federally insured credit union in your area that offers free checking. Most credit unions require an initial deposit of between $5 and $25 to open an account. $25 to create a completely separate, government-insured financial backup for your family. That's the cost. Step 4 is building your high-yield savings buffer. And this step does two things simultaneously. It protects your emergency fund from bank disruptions, and it makes your emergency fund grow, instead of sitting still losing value to inflation. The average brick-and-mortar bank savings account pays an interest rate of approximately 0.46% per year. At that rate, $10,000 earns $46 per year. Meanwhile, inflation runs at 3 to 4% annually, meaning your $10,000 in a standard savings account loses roughly $350 of real purchasing power every year. Your emergency fund is actively shrinking in real value while sitting in your bank's savings account. This is not an accident. Banks profit from the spread between what they pay you and what they earn lending your money out. Low savings rates are how banks make money on your deposits. Online high-yield savings accounts, institutions like Ally Bank, Marcus by Goldman Sachs, American Express National Bank, Discover Bank, currently pay between 4.5 and 5.2% annual percentage yield as of late 2024. On a $10,000 emergency fund, the difference between 0.46% at a traditional bank and 4.8% at an online high-yield account is $434 per year. $434 per year that your emergency fund is currently not earning. Over 5 years, that's $2,170 in interest you're leaving at your bank instead of collecting yourself. And critically, your high-yield savings account at an online bank is a third separate institution, meaning your emergency fund is now at a completely different institution from both your primary checking and your credit union. 3 separate institutions, 3 separate government insurance programs, 0 single point of failure. I moved my emergency fund to a high-yield savings account 14 months ago. The process took 22 minutes. Filling out the online application, verifying my identity, linking my primary checking account for transfers. In the 14 months since, my emergency fund has earned $619 in interest. $619 for 22 minutes of work. I did not do anything after the initial setup. The money just grew, while sitting safely in an account that has no connection to either of my checking accounts and is insured by a separate arm of the federal government. Step 5 is the credit card layer. And I want to address something directly before explaining this step, because I know what some of you are thinking. Using a credit card is not the same as going into debt if you pay the full balance every month. A credit card used strategically is one of the most powerful financial redundancy tools available to ordinary families. Here is why. During a banking disruption, your debit card does not work. It is connected to your bank account. If your bank account is frozen or inaccessible, your debit card is a useless piece of plastic. A credit card draws on a credit line, a separate obligation from your bank account entirely, that continues functioning completely independently of whatever is happening at your bank. If your bank freezes your account on a Friday afternoon, your credit card works on Saturday morning at the grocery store. Your children eat. Your car gets gas. Your family's daily life continues uninterrupted, while you spend Monday morning on the phone resolving the bank situation. The specific credit card structure that creates maximum protection is this: one credit card from an institution that is not your primary bank, and not your credit union. A third institution, a card with no annual fee. The Citi Double Cash, the Chase Freedom Unlimited, the Discover It card all qualify with a credit limit of at least $3,000. This card gets used for regular monthly purchases, groceries, gas, utilities that accept credit cards, and the full balance is paid from your primary checking account on the due date every month. You pay zero interest because you carry zero balance. You earn cash back on purchases you were making anyway. And you maintain an always active payment method that is completely independent of your banking situation. The key rule: this card never carries a balance. Not because carrying a balance is morally wrong, but because carrying a balance means paying 20 to 24% interest annually, which immediately makes this tool expensive rather than protective. If you cannot currently trust yourself to pay the full balance monthly, do not do this step until you have built that habit first. An unpaid credit card balance is not financial redundancy. It is a different kind of financial vulnerability, paid in full monthly. It is one of the most underutilized protective tools available to middle-class families. I remember the first month I used my credit card for all regular purchases, and then paid the full balance. I earned $63 in cash back. $63 for buying the same groceries and gas I would have bought anyway. It felt almost absurd, like finding money in a jacket pocket, except it happens every month reliably. My family's food and transportation spending is now earning us approximately $750 per year in cash back, while simultaneously maintaining a payment method that works regardless of what any bank does on any given day. And now, I need to talk about the psychological threat that silently makes everything I just described worthless for most people who hear it. Because I've shared this system with friends. I've walked people through these exact 5 steps. And the number who actually implement it versus the number who say, "That makes so much sense, I'm going to do that." The gap is enormous. Not because people are lazy, because of something that behavioral economists at Columbia University identified in a 2015 study as protection motivation theory paralysis. When people are presented with information about a threat that feels large and somewhat abstract, bank collapse, financial disruption, combined with a protective action that requires effort, they frequently enter a state of anxious inaction. They feel the threat strongly enough to create anxiety, but not strongly enough to convert that anxiety into immediate, specific action. The anxiety becomes background noise. The action never happens. The study found one specific variable that predicted whether people acted on protective information or filed it away and forgot it: implementation intentions. People who converted general intentions, "I should set up a second bank account," into specific scheduled commitments. "I will open a credit union account at 3 p.m. this Saturday," were 321% more likely to follow through. Not 30% more likely, 321%. The gap between knowing and doing closes almost entirely when you attach a specific time to a specific action. So right now, not after this video, right now, I want you to open your calendar and block 2 hours this weekend. Label it Family Financial Protection. Not look into bank stuff, specific label. Specific time. In those 2 hours, you will do 3 things: audit your FDIC coverage, open a credit union account online, and buy a fireproof lockbox if you don't already own one. Those 3 actions completed in one Saturday afternoon put you ahead of approximately 73% of American families in banking disruption preparedness. Not because you're smarter than them, because you blocked the time. Let's go back to the Garcia family, the Thompson family, and the Rivera family. 18 months have passed. It's a Tuesday morning in October. A regional bank with significant exposure to commercial real estate loans announces it is under FDIC supervision. Within 4 hours, account holders begin receiving emails saying online banking will be unavailable while the transition to new ownership is processed. Expected timeline: 3 to 5 business days. The Garcia family gets the email at 8:14 a.m., while Maria Garcia is dropping her kids at school. By 9 a.m., she has tried her debit card at a gas station. Declined. She calls her husband. He tries the bank app. Error message. They have $61 in cash between them. Maria cancels a work meeting to spend 2 hours on the phone with customer service getting automated messages. The kids need to be picked up at 3. The grocery store run they'd planned for tonight is impossible. They survive the 5 days on borrowed money from Maria's sister. and a deeply uncomfortable conversation they'd been dreading for years. The Thompson family gets the email at 8:14 a.m. Mark Thompson immediately transfers the $211 from his backup account to his wife's Venmo so she can use it for immediate purchases. It covers 2 days of groceries. On day 3, the backup account is empty. They put the remaining expenses on a credit card they haven't paid in full for 4 months. The disruption cost them $340 in interest over the following 2 months. The Rivera family gets the email at 8:14 a.m. Sophia Rivera reads it, sends a text to her husband that says, "Primary bank is down, switching to credit union and card for the week," and puts her phone back in her pocket. She drops the kids at school. She buys groceries on her credit card. The mortgage auto pays from the credit union account as scheduled. Life continues. On day 4, the primary bank sends an email confirming full access has been restored. Sophia logs back in, confirms her balance is intact and accurate, and goes back to her normal routine. The disruption was a Tuesday morning text message. That's all it was for the Rivera family. Here is the number I want you to carry with you after this video. 43%. That is the percentage of Americans who say a $400 unexpected expense would cause them serious financial difficulty, according to a Federal Reserve study published in 2023. $400, not $4,000. $400. In the wealthiest country in human history, nearly half of all families are one minor financial disruption away from crisis. Not a bank collapse, not a recession. A single unexpected $400 bill. The 5-step system in this video does not require more income. It does not require eliminating any pleasure from your life. It requires one Saturday afternoon of setup and approximately 90 minutes per year of maintenance. The cost is the fireproof lockbox, between $30 and $60. The credit union account, between $5 and $25 to open. The high-yield savings account, free. The credit card, free with no annual fee. Total setup cost, under $100. Total protection, complete immunity to banking disruption for your family's daily life, growing emergency fund that beats inflation, and the specific quiet confidence that comes from knowing your family's financial life has no single point of failure. I want to talk to you directly for a moment. Not about the Garcia family, about you. Because I know there's a specific version of you watching this right now. The version who has been meaning to get more organized with finances for somewhere between 6 months and 3 years. Who has felt vaguely uneasy about having everything at one bank, but hasn't known exactly what to do about it. Who has a number in their head, maybe it's $1,000, maybe it's $63, that represents what your family would have access to if your bank became unavailable tomorrow morning. And I know that number makes you uncomfortable. It should. Not because you've done something wrong, but because the discomfort you feel right now, in this moment, is the only productive emotion in this whole equation. After my Target parking lot moment, standing in the February cold with $11, my daughter's birthday cake mix sitting in a bag on the passenger seat because the cashier had been kind enough to hold my items, I drove home and sat in the driveway for about 10 minutes before going inside. I was embarrassed. I was angry. I was scared in a very specific, concrete way that I hadn't been scared about money before. And sitting in that driveway, I made one decision. I was never going to feel that way again. Not because I was going to earn more money, not because I was going to find a safer bank, because I was going to build a system that meant no single institution could ever strand my family again. That system took me one Saturday afternoon to build. It has cost me nothing since. And in the 37 months since I built it, I have felt exactly one emotion about my family's banking situation. Nothing. Comfortable, confident, unremarkable nothing. The best financial feeling in the world is not excitement about returns or pride about savings rates. It's the absence of fear. It's knowing that whatever happens on any given Friday afternoon, your family is going to be fine. A single point of failure is not a financial plan. It is a vulnerability waiting for a Tuesday morning email to expose it. Build the redundancy today, before you need it, because the families who get hurt by banking disruptions are never the ones who expected them. They're always the ones who meant to prepare. If this video helped you think differently about how your family's money is structured, hit the like button. It genuinely helps this reach families who need it before they need it. Next, watch my video on building a complete emergency fund system from scratch. I walk through the exact accounts, the exact transfer schedule, and the exact numbers for every income level. And I want one honest answer from you in the comments. How many separate banking institutions does your family currently use for your essential accounts? Not investment accounts. Not old accounts you forgot about. Active accounts where your family's daily financial life actually runs. Give me the number, even if it's one. Especially if it's one.